Sunil Subramaniam is joining us from Sundaram Mutual Fund to talk more about markets. Sunil, good afternoon. Thank you so much for your time. Congratulations, first of all, for a very interesting data point which caught our attention that one of your schemes, NAV, has hit 900 rupees. It must have started from 10 rupees a unit, I am assuming. How many years did it take? What kind of compounding did investors got if they held on to it for that entire period?
So it's taken a little over 21 years and the compounding was 23.41% per annum. So I think it's been an incredible success story, and those investors who've stayed the course have obviously, beaten every parameter that you can look at: inflation, fixed deposit returns, anything else, on such a thing. And I think it reflects the growth of India, because I think mid-caps are actually India personified. The Indian story, the journeys of mid-caps and domestic economy's growth, I think is reflecting in this fund. And I think that will continue because, as we all know now, the focus for the next half a dozen years is back on the domestic economy.
23%, just put it in perspective for our viewers and investors. At 23% compounding, your money doubles in what period of time? And if we hold it, say, for 10 years, every 3 years it's doubling, if I'm not wrong. And if we hold it for 10 years, what happens? And then if we hold it for 20 years, what happens?
It's doubled in 3 years. So in 6 years, it would have quadrupled. And in 9 years, it would have become 8 times. So in 10 years, you can see it roughly probably be 9 times. And so what this reflects is effectively that at a 23%, if you take the rate of tripling, so this money has tripled your money 3 times, right? 10 to 900 has gone up 90 times your 10 rupees. So it's just the power of compounding. I think it's truly, if you need to demonstrate to any investor who's entering the equity markets for the first time, the power of compounding, I think this is a real live example for you to take and to show. And also the fact is that it's been a journey of volatility. As you know, mid-caps are of more volatile than large caps. And the volatility has meant that, you stayed for the long run, you still made a phenomenal return. But more, if you had done it through an SIP, right, you would have innumerable corrections in the market thanks to various global financial crises or Russia-Ukraine war or COVID, which would have given you a wonderful opportunity to buy into the scheme. So a systematic investment plan would have delivered a phenomenal return. I think it's a classic textbook case which should be used in every introduction to equity markets to new investors as an example of what compounding can do for you.
Sunil, let me come to mid-cap, small-cap end of the market. Sundaram as a house has championed mid-cap, small-caps way ahead of many in the industry. Now, of course, it's a full-scale, full-service AMC, but I remember from 15 years back, 10 years back, when the specialization was small-caps. You understand that space well. That's what I'm asking you this question based on. Is it in a froth? Is it not right to generalize? How do you analyze small cap? So much money is getting concentrated there. People are excited. And of course, stocks have run up.
So I think the right way to look at it is from 2 perspectives, right? Because beauty lies in the eye of the beholder. So what glasses are you wearing to look at this, right? So if you are looking at making a quick buck, right? If you are looking at a 6 month, 1 year, 1.5 year kind of a time frame, right? Then obviously the kind of liquidity that has flown into the small cap and the mid cap space has made their valuations and their prices rise. So clearly, for those who wanted to make a quick buck, it's the money has been made and then they should just book their profits. And if you have an outlook of the next, say, 1 year, 1.5 years, clearly there is froth, because what's happened is that the floating stock in a small cap is far smaller than in a mid cap and far smaller in a large cap. Example of this is if you take the BSE 500 index, right? It's 500 stocks. But large caps account for 75% of the market cap, which means what? The top 100 stocks are accounting for 75% of the market cap. The balance 400 stocks are accounting only for 25% of the market cap. So the difference in floating stock clearly comes through. So the massive rally that you've seen in small caps and lesser in mid caps is a function of the fact that as FIs have been buying into Indian market, as you know, right from the middle of the March, FIs have been continuously pumping money into the stock market, and large cap valuations they rise. Domestic fund managers, whether they be mutual funds or insurance companies or whoever, have been tending to sell the large caps to the FIIs and reallocating that money into mid and small cap. That's one primary reason driving that. Second is you're seeing that the large amount of demat accounts which are open, which is indicating that a large amount of retail investors kickstarted from COVID onwards, with maybe a lot of time on the hands, a lot of money on the hands, have started trading and speculating in the stock market. These Robin Hood speculators, as you may call, obviously are going by tips in the market and buying those which are recommended, right, through various fin influencers and everybody else. So they are going into the low liquid stocks, and that buying, even a small amount of buying, is kicking it up. The third aspect there is that given the fact that domestic investors have been increasingly buying SIP book, and it's almost at 16,000 crores this month, the volatility of the mid and small cap means that advisors and distributors have been recommending them to take SIP approach to the mid and small cap space. So a lot of the increase in the SIP book has happened in the mid and small cap. So what happens is that fund managers are getting money into mid and small caps every month. That can't be used to buy large caps because the rules are pretty strict, right? You have 65% of a small cap fund has to be in small cap, 65% of mid cap fund has to be in mid cap. So this increase in the SIP book around the mid and small cap means there's concentrated flow coming into it. So these three factors, right? First is the reallocation of flows by fund managers as FIS coming to large caps into mid and small cap. Second is these Robin Hood speculators coming at the bottom end and buying those penny stocks in the hope of quick. And third is the SIP book of mutual fund investors itself getting allocated into mid and small cap means that there is a rush of liquidity in that segment. And while the story behind mid and small caps from a domestic economic growth perspective, the capex cycle driving it, the discretionary consumption cycle is expected to come, is naturally good, the market has been buying those stocks with this hope for the future. Now, in the medium term, over a 3 to 5 years, the earnings growth of small caps and mid caps will definitely achieve these expected EPS numbers because the valuations are reflecting expected EPS and beat them. So if you're an investor for the long run, then you don't worry about the current, whatever you call as froth, or the higher valuations on a trailing basis, or the higher valuation of 1 year forward PE. If you take a 3 to 5 year outlook, you would still make decent returns from the mid and small cap space. The danger is that investors who come with 12 months and 18 months, right, if they see some kind of a volatility, these Robin Hood speculators, as they call it, they might panic and tend to pull their money out. So what leads to a sharp rise in the stocks can lead to a sharp correction. But to an SIP investor, right, any such corrections which happen because of these factors means that he's able to buy those same mid and small cap units at a lesser NAV, thereby adding to his wealth creation potential for the future. So an SIP investor to continue to stick at it, any volatility that's going to come because of the so-called froth in this space is going to actually lead to a benefit for acquiring more units. The second aspect to also bear in mind is the large cap space where your FIS continuously put in money. Now, there, as you know, FIIs are a function of a TINA factor, right? They're looking outside India and saying India is a better bet. Now, oil prices are at 91. Fed is talking about rate hikes. So there could be short-term volatility because oil plays a big part in a hedge fund's approach to India because there is currency impact because of oil increasing. There's also EPS impact. So if large cap FII investors tend to take out money, profit booking, and December is coming when typically hedge funds book profits. When they take out, then mutual funds will tend to go and buy when those large cap prices fall because they're getting good quality companies at better prices than a month ago or 2 months ago. So that reallocation will mean that some amount of money may be pulled out of the mid and small cap by fund managers to go and buy those large caps which are being sold by the FIIs. So the mid and small cap could be in for a period of volatility, bear in mind. To the SIP investor, that's a great benefit. But to a short-term investor with a short-term outlook, I would say you better either stick to SIP as a route or you allocate to a flexi cap or a multi cap kind of a category.
Sunil, what do you have to say about the SIP number itself? It has nudged closer to 16,000 crore. The way momentum is, right now, What is the potential of SIP numbers going up? Do you think this momentum may continue? If you look at 2 to 3 year, is it structural and sticky?
I think that one of the key things I think we have to appreciate is the value that advisors and distributors, the mutual fund distributors, MFDs, and the bank salespeople, right, have brought in. Is that what they have found is that most people get income on a monthly basis, and I think booking an SIP with them as a entity is a much better than going and seeking a lump sum. That's number one. I think the maturity of the distribution network has to be praised here in India, that increasingly customers' money is not being dumped into a lump sum, but being brought gradually. This has multiple effects there. And I see that this, because it's like a self-fulfilling prophecy. All the SIPs over the last 1 year, see, from about 12,000 odd crores in about a few months and years ago, it's now 16,000. So that's a 25% increase, has meant that there's been a good investor experience. And hence, this will feed into people increasing their SIPs even more. So I would say that in a year from now, I wouldn't be surprised if this SIP number were to touch 25,000 crores. The way which the momentum is building. So 1 year from now, I would say at 25,000 crores a month, we would be, really working on this growth pattern, as you can see.
25,000 crore in a year from now is the potential SIP number which Sunil looks at after spending 30 in the industry, when he's saying that you better take stock of that. In fact, thank you very much, Sunil, for your time this afternoon. That was Sunil Subramaniam.